Hello and welcome in our presentation about the scientific paper. I would start this presentation with a simple question. Would you invest in a company with an high ESG score, knowing that it could maybe give you some higher returns, given the fact that they have less risk compared to other companies? Well, in this presentation, we will present to you a paper named Is ESG an equity factor or just an investment guide? But before making this presentation, we wanted to apologize to do this presentation via Teams because during this exam period, it was a bit hard to find the place and the time to make this presentation in the same place. So we decided to make it via Teams. So to summarize the main issue tackled with this paper is that the ESG score is more and more common nowadays in the investment sphere. Investors want more and more discourse, and really some studies have shown that some higher ESG scores leads to a higher risk-adjusted returns, and this study aims to test if this proposition is true or this ESG performance are linked to other factors like the size of the company, as we will explain later.
About ESG as an investment strategy. So nowadays, ESG investment has exploded in popularity. Like the interest is growing, and the asset manager are actually incorporate more ESG assets in their portfolio. So this study does not focus only on a specific ESG criterion, but group the three ESG criteria by including these three pillars in a global investment portfolio in a 10-year period to take a more holistic approach to analyze this impact. So about the data used, these data are used from the MSCI database that provide a rating for like 16,799 companies from January 27 to October 2017. We can see in the graph from the data coverage that in 2013 there was fewer data than the other years after and just before, but this is not having a significant impact in the study. And the MSG ratings assess companies based on like carbon emission for the E pillar, health and safety for the S pillar, and like the compensation structure and the management for the G pillar, are score from 0 to 10. And to collect this data, they use public and private survey.
Okay, so for the methodology, so the idea of the study is to know if an ESG strategy will have significant risk-adjusted returns than another strategy. So the first action they made was to transform the ESG scores into a portfolio with on a scale from -1 to 1. The idea is to have the good ESG scores with a positive weight and the bad scores with a negative weight. So with these scores, they construct a market neutral portfolio. What is a market neutral portfolio? The idea is to have a portfolio where when you have a positive weight, you are basically buying the stocks, you go long. When you have a negative weight, you short the position, meaning that you sell the stocks. This idea is really to have a nudgy strategy, and with this strategy, they will construct this portfolio and will try to explain the returns of this portfolio with well-known factors like we can have in the Fama French or the Carhart model. So for that, they took only 6 factors. In their study, they mentioned also some other factors, but the other 2 factors were all highly correlated with the 6. So they decided to go with the low beta, meaning that this is mainly um, the market, the performance of the market, the book value, the profitability, the accruals, momentum, and the last one is the size. With this portfolio, so they construct, Ali, if you can change the slide for
Yeah.
the, okay. So they decided to choose some companies listed on several exchange and also from several geographical points. So there were like a pool of 1,000 stocks from the USA and the Europe, also 200 from Australia and Canada, and lastly 500 from Japan. So after making this portfolio, they compute the profit and losses from the the total companies, and they try to explain it with the factors as Alistair will mention it in later. But first, they conduct um, a, a regression to know if there was any bias in the EEG scores uh, with the measure.
So, for the bias in the ESG factor, the study highlights some bias about the volatility. They highlight the fact that the companies with lower volatility have a higher ESG score. They highlight the fact that large cap market companies has higher ESG score than the others, and they highlight a problem about a geographical bias. Like in some countries, the company were having higher ESG score than in other countries, and it can be related to the regulatory difference between the countries. So about the results of the study, they highlight the fact that the ESG score does not appear to deliver a higher risk return from other strategies, like with a Sharpe ratio close to 0. Um, like the ESG difference about the risk return seems to be explained by the other factors, like in the momentum and the psi factor. This is confirming the bias that we highlight on the previous slide. Um, they see a difference for the governance pillar by having a superior Sharpe ratio from 0.46. But this can be explaining by the fact that companies that have having a better management are more efficient and are more efficient. And according to the authors, so this result is explained by the profitability factors. So for the conclusion of the study, they highlight that the fact that the results from the ESG factor on the return are already captured in established equity factor. like the profitability. And moreover, the ESG score does not do not appear to negatively impact the returns. So this is it for the conclusion of the study.
Okay, so as Alistair just mentioned, so the ESG strategy uh, return seems to be explained by the factors they added in their regression, but this results have several limitations as they mentioned in the paper. We will first share to you the limitation share in the paper, then we'll share our thought about the limitation also from these results. So first they mention the data providers. Obviously nowadays we can find a lot of different ESG scores with sometimes some conflict saying that one company is having a good ESG scores, the other one saying that this company have bad scores. So the divergence across ratings from different firms create really confusion and make it unclear which one to trust. There is also a lack of transparency in the model used uh, to compute these scores. So most of the rating companies are private agencies, and sometimes they don't really share the models they are using to compute these scores. So you don't really know how they compute these scores, and you have an impression that the scores are pulled out of the hat. They also mentioned the quality of the data. So we really started to measure the OEG scores like 25 years ago. So we don't really have high quality data over an extended period. So this is a bit hard to have robust results for several for a regression. That's why they highlight the fact that there is maybe a need for a standardization, but also for a clear regulation from the authorities. Uh, that was the limitation mentioned in the paper. We'll now share our thought about this limitation. Uh, the main limitation we think is that the paper shows that the origin scores are computed more in a linear way. They compute a social pillar, governance pillar, and so on. Then they aggregate it to form the origin score. There is no really a non-linear approach, and when we see in our course of sustainable finance is that climate is much more complicated than only linear relationships. There is some loops, there is tipping points, and so on. So this really make the results a bit biased, we think. There is also the fact that following the paper, the factors are causing the profit and loss of the company. But in reality, we think more that a company with a high ESG scores will have less climate-related risk. With less risk, this would mean that they could have a better risk-adjusted return, but this is more a loop than just one causing the others. Also, the models behind the AG scores are not clear. We really think that we need complex thinking, also thinking more in a holistic way, uh, and having the idea that things interact are intertwined, and we really need to have a network approach rather than one uh, one thing causing the others. So I will now let Alistair present to you the improvement as I just mentioned a bit, sorry.
So for the improvement of this paper, The first idea and the main is to develop new metrics that are clearer and more precise, that adapting to different scenarios, contexts, and to take in account like the geographical parts, the companies, the size, etc. The idea is to make a difference between metrics for the micro, the meso, and the macro levels. And so, as it was mentioned in the paper, there is a need for a stronger theoretical foundation, especially for the standardization and the regulation, for example, to avoid the conflict of interest created by the construction of the ESG score.
Okay, so now we are going to discuss the contribution of this paper to more socioeconomic system. So first, one interesting result is that they conclude in their studies that ESG strategy does not seem to harm the financial performance, which supports the idea that sustainable investing is possible. We just have to really make more attention to what's into what we are investing in. So also another point is that they say in the study that investing in UHG doesn't offer any superior risk, but we really think that with the limitation we just previously mentioned, these results are not really taking the whole picture into account. That's why we think that we really need some more accurate and other measures to better understand what are the risks related to the climate. One other's insight, given the contribution to the socio-economic system, is on the next slide. Okay, so it's the fact that okay, the ESG scores following the study does not provide any risk-adjusted returns, but this can still be a guide for the investors, for an investor who seeks to invest in a more sustainable way. One disadvantages also of the ESG score that we've noted is that maybe some company could have an incentive to maximize their scores to attract new investors and do a bit of greenwashing, and they just focus on these scores, not really uh, focusing on the accurate impacts on the climate and on the society. That's one thing that we can also see in the sustainable development goal. We have to take the whole 17 goal into account, not only focus on one indicator. That would be a complete bias in the results.
So, for the conclusion, um, as we can see from the study and what are we thinking is that the ESG score cannot be considered as as a new equity factor because the returns from this ESG were already measured from the other existing traditional metrics. Um, Secondly, ESG factor does not reflect the reality from the companies. Like we say, the companies are doing only, some companies are doing only um, environmental improvement to improve their ESG score and not really focus on um, the long-term environment. And the short data for the short period for the data make the study not really representative for the long term and for the actual year because it finished in 2017. So for the long term, we can discuss about the reality of this study in the actual world. And so we highlight the fact that it is really important to develop some new model and metrics that are more precise and take the context and the scenario in case. So thank you for this presentation. If you have any question, don't hesitate to send you an email or others. Thank you. Bye.
Thank you. Goodbye.